When considering where to do business in Europe, VAT is one of the most important factors to understand, and Denmark offers a particularly clear example of how a mature, high-income economy structures its system. In this video, we will walk through how Denmark's VAT works in practice, how it compares with rates across the European Union, and what this means for companies operating in or selling into the Danish market. Let us start with the basics. VAT, or value-added tax, is a consumption tax applied at each stage of the supply chain, from production to the final sale to the consumer. Each business charges VAT on its sales and can deduct the VAT it has paid on its inputs, remitting only the net amount to the tax authorities. In Denmark, the standard VAT rate is 25%, and it is notable for being both relatively high and unusually simple by European standards. Unlike many EU countries, Denmark does not use a complex structure of multiple reduced rates. Instead, Denmark applies a single standard rate of 25% to most goods and services, with only a limited set of exemptions. This simplicity reduces administrative friction, but also means that consumers do not benefit from lower VAT on categories like food or domestic energy, which are often favored in other EU jurisdictions. From a business perspective, understanding the scope of Danish VAT is essential. Most commercial supplies of goods and services are subject to the 25% rate, and businesses registered for VAT can normally deduct input VAT on purchases directly related to their taxable activities. Certain sectors, however, are exempt, in line with EU VAT directives. These typically include financial services, insurance, healthcare, education, and certain cultural or social services. For exempt activities, there is no VAT on the output, but also no right to deduct input VAT. This has implications for pricing and margin management, since VAT incurred on inputs becomes a cost rather than a pass-through. Businesses operating in partially exempt sectors need careful allocation and documentation to ensure correct treatment of recoverable and non-recoverable VAT. When we place Denmark into the broader EU context, the 25% standard rate stands at the upper end of the range, but it is not an outlier. Across the EU, standard VAT rates currently sit between roughly 17% and 27%. For example, Luxembourg is at the lower end with a 17% standard rate. Germany, as one of the largest EU economies, applies a 19% standard rate. France is somewhat higher at 20%. Spain stands at 21%, while countries such as Italy and the Netherlands apply 22% and 21% respectively. At the high end, Hungary has a 27% standard rate, and several Nordic and Baltic countries, including Sweden and Finland, operate standard rates around 24%. Denmark's 25%, therefore, positions it among the higher rate jurisdictions, broadly in line with its Nordic peers. Where Denmark really differentiates itself, however, is not just the headline rate, but the absence of broad reduced rate categories. Many EU member states have extensive reduced or super reduced VAT rates for specific goods and services. For example, Germany applies a reduced rate of 7% on many food items, books, and certain cultural activities. France applies reduced rates of 5.5% or 10% on food, certain transport services, and some energy products. Italy and Spain also maintain reduced rates for staples and socially sensitive goods, and several countries use very low or zero rates on items like books, medicines, or children's clothing. These lower rates are often used to pursue social or policy objectives, such as reducing the tax burden on essential consumption or supporting cultural sectors. Denmark, by contrast, has chosen a model that favors uniformity over targeted relief. The Danish system applies the 25% rate to most categories, including food, with only exemptions rather than reduced positive rates. For businesses, this has both advantages and trade-offs. On the positive side, the system is easier to manage. There is less ambiguity about which rate applies to which product, fewer classification disputes, and simpler compliance processes. This can reduce administrative costs for both domestic businesses and foreign companies selling into Denmark. It also means that pricing strategies are more straightforward, because there are fewer VAT-driven distortions across product categories. On the other hand, the absence of reduced rates can translate into higher consumer prices on essential goods compared with markets where food or energy benefit from preferential VAT treatment. From a policy perspective, Denmark tends to address distributional and social concerns more through direct transfers and targeted welfare policies than through differentiated VAT rates. For companies operating cross-border, the interaction with EU rules is key. Under the EU VAT framework, Denmark is required to follow common principles, but retains discretion within agreed ranges for its standard rate and for exemptions. Businesses selling goods to Danish customers must consider VAT registration thresholds, distance selling and e-commerce rules, and the place of supply rules for services. Digital services supplied to Danish consumers, for example, are generally taxed in Denmark at the Danish rate, even if the supplier is established elsewhere in the EU. The high uniform rate underscores the importance of robust invoicing, accurate classification of transactions, and well-designed systems to track input VAT recovery. For companies with activities in multiple EU countries, Denmark's profile can also affect strategic decisions. A uniform 25% rate can simplify financial modeling, but it may make Denmark a relatively high VAT environment for consumer-facing sectors, such as retail, hospitality, and food services. In contrast, a company selling specialized business-to-business services may find that the impact of the high rate is largely neutral, since both the supplier and the customer are VAT registered, and VAT is ultimately recoverable. When comparing Denmark to other EU member states, senior decision-makers typically weigh three dimensions: the headline rate, the complexity of the rate structure, and the consistency of enforcement and guidance. Denmark scores high on the headline rate, low on structural complexity, and relatively well on predictability and administrative clarity. For many organizations, this trade-off is acceptable. Paying a higher rate is manageable if the rules are transparent and stable, and if compliance risk is lower due to fewer gray areas. Looking ahead, Denmark's approach is broadly aligned with an EU-wide trend favoring digitalization and simplification of VAT compliance, including e-invoicing, improved reporting obligations, and tighter control over cross-border transactions. While major rate changes are always a matter of political choice, Denmark's fiscal model and public spending commitments mean that any moves to lower VAT would need to be balanced against broader budgetary considerations. For now, businesses should plan on the basis that the 25% rate and the simple structure will remain defining features. To summarize, Denmark operates one of the EU's highest standard VAT rates at 25%, but offsets this with a notably streamlined structure, relying on a single standard rate and a narrow set of exemptions instead of extensive reduced rates. Compared with other EU countries, Denmark trades off lower complexity and greater predictability against higher tax-inclusive consumer prices in certain segments. For businesses, this environment rewards strong VAT governance, accurate transaction mapping, and careful planning around exempt activities. By understanding how Denmark's VAT fits within the broader European landscape, companies can make more informed decisions on pricing, supply chain design, and market entry, ensuring compliance while optimizing their commercial position in a high-rate but highly transparent VAT jurisdiction.